An S corporation can help you to reduce business taxes, whether you're a physician or not. The main way in which an S corp reduces taxes is by taking some of its income as a distribution and some of its income as wages for the owner. The money that is taken as wages, you have to pay payroll taxes on, such as Social Security and Medicare. The money that is taken as distribution does not owe payroll taxes on it under current law. And so by the more you can call distribution and the less you call wages, the more money that you can save on taxes. For a typical physician, those are just Medicare taxes, so it saves you 2.9% of the amount you call a distribution. For somebody with a lower income, especially if you're below the Social Security wage limit of around $142,000 or so, that can be a more substantial savings because you're saving both halves of the Social Security taxes as well. An S corporation can also have a health insurance plan that can cover you or your spouse, along with your dependents. And so you need to make sure that the S corp pays for your insurance premiums directly or through reimbursement, and needs to include that as wages on your W-2. Then you can deduct the cost of those premiums using the self-employed health insurance deduction on Form 1040. You can also, like with many businesses, engage in some other shenanigans to lower your tax bill. Employing your child is one that a lot of businesses use. However, you have to be careful with this with an S corp. It's actually better off using a sole proprietorship or a partnership, because if you employ your child in your business, that the only owners are the parents, they don't have to pay payroll taxes on that income, and most of them don't make enough money that they have to pay any income taxes at all. Then they can turn around, because it's still earned income, and put that into a Roth IRA. You have to be careful in an S corp, though, because that rule does not apply. In an S corp, you have to pay payroll taxes on the kids, even if the only owners of the S corp are the parents. You can also take advantage of other deductions. The home office deduction, for instance, the simplified version is basically $5 per square foot, up to 300 square feet of space that you use exclusively and regularly for the business. If you're using that space for other stuff, you can't take that deduction. A more substantial deduction is renting your house to your business. And again, you don't have to be an S corp to do this, but you can rent your entire house for up to 14 days a year. And it's a deduction to the business and not income, not taxable income anyway, to you personally. So that can be a pretty significant deduction. You can also use accountable plans to reimburse travel expenses or cell phone expenses that are used for the business. You can also reimburse, vehicle mileage as well. Be sure to keep a mileage log for that, of course. And then with any business, it's a good idea to have some sort of a retirement plan, whether you're an S corp or not. Solo 401k is probably the one doctors use most frequently, but there are also SEP IRAs and simple IRAs that might make more sense if you have employees. Basically, those plans can allow you to contribute up to 6 figures if you also include a defined benefit plan, along with your other retirement accounts, such as a backdoor Roth IRA for yourself and your spouse. Lots of business deductions are available through S corp and other businesses. You should definitely look into them if you are self-employed at all.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.